Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me today is Michael Gayad. And we are going to start a new monthly series here on the show where we're going to talk about where we see risk on and where we see risk off. Talking about risk on and risk off with Michael Gayad is incredibly easy. If you follow or subscribe to his lead lag report, he lives and breathes this stuff. Michael, you were one of my most popular guests last year. I appreciate you coming back on again this year.
Hey, and my mom kept on refreshing the screen, is what it is.
My mom too. That's what helps our stats, right?
You got to get your big fans, right? So why not?
Well, if you want to talk about stats and playing with the Twitter and LinkedIn algorithm, we have to start with talking about GameStop. Michael, what's your take on this nonsense?
I mean, I think the word you just used is the correct word. It's nonsense. It's funny. We entered a world where everyone's talking about the Fed manipulating markets, and now you've got Reddit with some of these comments that have and some of this sort of ganging up of taking on some of these heavily shorted stocks by a bunch of smaller traders that in aggregate actually have a lot more power than probably most people realize. Look, I mean, this is not unusual, especially when you're in these kind of speculative phases of the stock market. You see very bizarre behavior, and with the sheer amount of liquidity in the system, again, it should surprise nobody. I would caution anybody in terms of thinking that's a way to get rich quick. Yes, some people probably did. But there's a difference between investing and gambling. I would say this is more the latter. It's fun to watch, and God bless those that made a lot of money on it. But to me, it's more of an example of sort of where we are in the cycle in terms of this fervor, this FOMO, this desire to just manipulate, and who cares about what the message of stock prices actually means for growth and for what a company's fundamentals actually represent. As I was kind of aggressively kind of tweeting out last night, when the stock market becomes a video game, it's game over for the capitalist system. And some people took issue with that message, but I really do believe that. I mean, people forget this is not just a game about stocks going up and down. The stock market is supposed to be reflective of the future. There's important signals that the stock market has on the entire value chain, on suppliers, on customers, on what the Fed does. And the more that you see this kind of speculative behavior, it actually creates a tremendous misallocation of capital in terms of longer term, what should be treated the best based on fundamentals that are what all stocks should ultimately be based off of.
Yeah, and you and I have spoken about this before. It's really easy to start making comparisons to 1999. But for the financial advisors out there watching this show, in charge of people's money, most of them in a fiduciary capacity, what do you do now? What do you do with new funds that are brought into a client's household and they have to be allocated?
So I'm a little biased here, because I talk to advisors, as you know, all day long, and that sentiment is actually one that's getting more and more serious, right? Because some advisors have gotten new clients, new assets, and they're very afraid about chasing equities. And the moment they put that new client money in, what if they have a drawdown out of the gate? This is where some of the stuff that I do, whether it's the ATAC rotation mutual fund or the ETF RORO, some people think that makes some sense because they're risk on, risk off approaches that are wildly dynamic in trying to identify risk on, risk off conditions. But it's tricky. I mean, because as we know, extremes can get more extreme. Overbought can stay more overbought. I mean, it can get even crazier than it has been so far. So I think the best thing to do for advisors here is probably just average and manage expectations, try to diversify away from just tech and standard sort of buy and hold investment themes that have been incredibly hot. The managing of expectations is really critical when you have everybody's expectations so firmly on the side of up and to the right, that's probably more important than the exact day that you buy.
Yeah, I mean, old-fashioned dollar cost averaging seems to always work. You still really got to hold your nose right now. And gosh, last time you and I talked about that as it related to emerging markets, some of that has paid off since the last time you've been on the show, but it's just a function of having that investment strategy to get in, but it still makes it hard. Michael,
yeah.
I'm sorry?
No, I was going to say, and it kind of goes back to the point. I constantly use this line, right? Your ability to stick to a strategy matters more than the strategy itself. So, but part of that sticking to a strategy is managing expectations, right? As far as where we are in the very, very short term, which by all metrics seems to be fraught with all kinds of risks and dangers that nobody seems to be caring about.
Yeah, that's right. So if you're watching this interview live on Twitter, LinkedIn, Facebook, or YouTube, and you want to ask a question, simply type a comment and it will come through to Michael and I. Now, Michael, you're one of the easier guests to interview because you put so much content out there. Just an hour ago, you posted this tweet from your Wide Charts account of the S&P 500, and for audio listeners, it's juxtaposed against the M1 money supply. You can see the very high correlation last year, and now there's been a divergence where M1 is significantly above the markets. What is this telling you?
Well, so there's one perhaps major interpretation, right? If you're going to bet on the bull case, it's that the stock market catches up to the money supply. And quite frankly, given how TIPS, Treasury Inflation Protected Securities, have been so vertically outperforming nominal treasuries, meaning inflation expectations have been skyrocketing, yeah, maybe there is an argument actually that the stock market has a crack up boom. I don't think so, though. And I'm saying I don't think so because at some point the reflation narrative, which everyone seems to be betting on, by the way, including myself, I'm on that same camp longer term. The shorter term may actually end up being very different. If there's an overreaction, at least near term, to this sort of reflation narrative, in which case money supply may actually keep going up and the stock market actually may go down, despite all the dollars that are being printed. So, it's, and look, this is not uncommon, right? Correlations break. I mean, unequivocally. At some point, something gets too stretched, and then the causation and correlation somehow just reverses, right? We don't know why, we don't know when, but it certainly could be the case. I was looking at a chart earlier. When you look at expectations for yield curve steepening, the last time we saw expectations this high for yield curve steepening, which would be bullish for equities, happened pretty much in every single major instance just before the yield curve started to flatten historically. So, as Bob Farrell once said among his 10 rules, when everybody thinks one way, something else is about to happen. So a lot of people looking at money supply saying, well, all this money's in the system, markets have to go up. Well, if everyone thinks that, maybe the payout's higher and betting against that.
So I'd be remiss if we didn't go a little bit deeper then on tips, and specifically through the lens of a financial advisor. How viable are the ETFs that provide exposure to that space, or do you feel you're better off with an active manager when leveraging that security, that type of security?
So I look at tips from the standpoint of what it's signaling. And of course, the issue with tips is that it's based on, inflation, CPI, and who really knows if that's actually the accurate way of measuring inflation. So funny because we always talk about inflation and deflation, but it's actually very hard to get down to an actual agreed upon, universally formed number in general. So I look at more tips from a sort of signaling standpoint as opposed to sort of the ETFs. Now, having said that, tips are unique, right, in the sense that they can provide some degree of inflation protection and they can still be a risk-off play, even though risk-off plays tend to coincide with disinflation, deflation, because even though the inflation coupon aspect of it might drop, the flight to treasuries, it still would co-move in those kind of risk-off, high volatility stock market periods. So I think tips are kind of an interesting way of playing risk off from a sort of strategic allocation perspective. If you believe that reflation is here and that the Fed is going to get its way, which again, I do believe they will. But at the same time, it's not sort of, I think, the ideal way to play reflation or the ideal way to play deflation. If you're tactical, the best way to play reflation tends to be equities, highly levered ones. If you're tactical, the best way to play deflation risk off is with long duration treasuries. Tips are sort of a way of just holding without necessarily having to sort of try to figure out which regime we're in.
Michael, what do you think about the ETF wrapper for tips specifically?
Well, look, I mean, I think in general, ETF wrappers are solid because they provide sort of a degree of not having to worry about resetting your duration, right? Because if you were to go out there and obviously buy treasuries, you've got an endpoint, right? You've got maturity. And the nice thing about ETF wrappers is that it's constantly trying to maintain that maturity. It's actually doing the buys to keep the exposure continuous. So I think there is a nice aspect of that wrapper for that to be able to kind of actively maintain the constant life of the treasury security. And ETFs, as we know, are obviously very tax efficient. So that I think certainly helps in terms of any kind of rebalancing that might occur on the fringes to sell and buy as necessary. So yeah, I'm a fan of the ETF wrapper within the treasury space, and as a matter of fact, I do it myself in the RORO ETF as well as the mutual fund ATAX.
Excellent. And where could listeners and viewers find out more information about those products that you manage?
So separate from the lead lag report, I manage the mutual fund ETF, atacfunds.com, atacfunds.com. ATAC just stands for atactical. I'm actually been quite happy. I mean, RORO, the risk on, risk off ETF that uses lumber to gold as the trigger, has been getting some really nice attraction from an asset gathering perspective. And I think people are getting tuned into the idea that at some point down capture will matter again. And while that is nowhere near a guarantee that what I do will work, at least I have a chance, unlike most others that are just simply playing risk on, playing beta, playing the most speculative stuff, which means they will inevitably take the hit whenever it breaks.
So I've already found our line from the show. At some point, down capture will matter again. We have a whole generation of financial advisors that started in, 08, 09, 10 or later, and they've never had to worry about that metric or understand the importance of it. And I think that if we do end up with one of these black swan events that you've been talking about on social media, they're in for a real surprise. Can you help the advisor who hasn't been through a real bear market? I'm not calling last year a bear market. A real bear market in managing client expectations in their portfolio and their money. What do they need to be thinking about today at the beginning of 2021?
So look, I use this line, and actually it didn't get as many retweets on Twitter, but actually I think is a very strong line, which is that path matters more than prediction in markets, especially when you're managing other people's money, because you could be right being bearish, but if you're right a year from now and you're bearishly positioned now, your clients are probably not going to stick with you that long, right? As an advisor, right? The path under which some prediction takes place matters more than the prediction. And I think that that's critical for advisors to recognize, which means you have to have multiple investments in a portfolio that can play multiple different paths, and perhaps simply weight the investment that might have more exposure to the path you're betting on, but again, not knowing exactly when it occurs. Yeah. That's why I'm not a fan of shorting. That's why I'm not a fan of going to cash as your sort of expression of that potential bear market. And I agree with you, by the way, about last year. As far as it was a crash, not a bear market. A bear market, which you can say is a prolonged decline or maybe even a prolonged crash, requires the proper tools and the proper mindset to walk down the right path whenever it occurs. Again, in the case of the ATAC funds that I run, it's very path specific, but I really do believe this point that predicting is nonsense. The only thing you can do is tell the weather, and the path under which the market behaves will determine performance and your own clients sticking with you more so than anything else. And to be clear, by the way, just to make this more obvious, right? I took on a much more negative and risk-off bearish tone recently on Twitter, not because I'm anticipating it's going to happen tomorrow. I'm simply anticipating that when you have sentiment this frothy, when you have leading indicators starting to look like they are bottoming, suggesting risk-off conditions are coming, that's a game of managing your own expectations for yourself and for your clients. Doesn't necessarily mean you have to act on it right away, right? But every day that gets closer, that goes by, you're by definition closer to something changing. And this has been such an unrelenting bull market. This has been such an unrelenting frothy environment where seemingly everyone only cares about the upside, that it doesn't take too many butterflies flapping their wings to create another hurricane in markets, especially when debt is this high.
Path matters more than prediction. I like it. That's what we should call this show that we do each month, because that's the core of it. That's the essence of it. I was telling some advisors who were a little concerned about managing client meetings last year. And then, of course, the market started to ramp right back up and those expectations were gone, that if you haven't been through it, you don't know what it's like to have 3 consecutive review meetings with a client where each review meeting, the value of their portfolio is down significantly. And you're kneecap to kneecap, and they're questioning whether they're going to be able to retire or send their kids to college. And that's what I think advisors who haven't been through it before just aren't prepared for right now.
Yeah, and it's exhausting. And it's also necessary. Right, because the reality is the role of the advisor. It's funny. Somebody was saying, well, there's a bunch of people that don't like somebody almost having a bitter response to one of my tweets saying, you're getting upset about the removal of the middlemen because I was ranting about how individual investors are creating these kind of misallocations of capital. Well, I'm sorry. The middleman's actually, in this case, quite useful if the middleman keeps you in the game and keeps your own emotions in check. I mean, the role of an advisor is not to manage money, it's to manage risk and to manage emotions. I don't think you can necessarily do that, with due respect, on Reddit or on any of these other platforms that people are just using to try to game the system. The long term, listen, returns take care of themselves. Risk matters more than anything else. I know it's not sexy. I get it. It's not appealing to talk about risk off, to talk about being down less when everything's going up. But show me anybody that's been in this game long enough that only is focused on the upside, and I'll show you somebody that is akin to Madoff. It doesn't happen. It's not real. You have to manage risk. Return will follow. And the advisor's role is to manage the risk of the portfolios, but more importantly, the risk of the client doing the wrong thing at the wrong time.
Manias are fun if you're long and bullish. They're an absolute travesty on the other side. And just not enough people have had enough experience with it. So hopefully they understand the importance of using strategies like you have in any type of diversification strategy. Speaking of manias, I'd be remiss if we did not spend a little time talking about Bitcoin and juxtaposing it with gold. So for viewers, I'm going to run through 3 charts. It's the 3-month, the 6-month, and 12-month of Bitcoin and gold. You and I, and quite frankly, a lot of my guests over the past 18 months have talked about gold and Bitcoin in a portfolio as a type of hedge. But I haven't asked you specifically, Michael, where do you put Bitcoin and gold inside of a portfolio?
So look, in general, they're both in the alternative allocation. I don't believe they are meant to be core, but some people do view them as core. I don't believe Bitcoin is a risk-off play because no evidence suggests that on a correlation basis. Now, that could change as Bitcoin becomes a more mature asset as opposed to, one that moves so violently that you can argue it's more speculation than anything else. Gold tends to historically be more of a safe haven risk-off commodity. And listen, I hear all the arguments that Bitcoin will keep rising because of institutional demand, because of look at how big the gold market is, and Bitcoin can easily overtake that. That could all very well be true. The only thing I would say about this is, and we're already seeing some of the rumblings around this, if Bitcoin is meant to challenge the Fed, don't think the Fed's going to go down without a fight. Okay, and you're seeing that even with some of these comments with Yellen, as far as talking about how Bitcoin probably needs some degree or more regulation, which is debatable even if you could do that to begin with, given the way the decentralized nature of Bitcoin is. But this is going to be a battle, and it goes back to path over prediction. All right, you have all these people that have been predicting 100,000, 200,000, $1 million on Bitcoin. They never really tell you when, and they never tell you the path in between. Mm-hmm. And the path is what will determine your likelihood to stick to that asset, right? So I think it's in that alternative 5, 10, 15, 20% maybe range of an allocation. I believe concentration in anything, whether it's Bitcoin, the stock market, or anything in terms of an asset allocation, in general is a mistake. As you and I have talked about this before, never have conviction. The best way to manage money is to be dynamic and realize that you don't know the future, so you might as well not be so convinced of it.
Excellent. Michael, I appreciate you coming on. For listeners and viewers, if you'd like to subscribe to Michael's letter, please visit leadlagreport.com. That is leadlagreport.com. It's one of only 4 letters that I read on a regular basis. Michael, thanks for coming on.
No, my pleasure. Thank you.